Hey, this is Josh Taylor with Trade Advisor Pro, and I want to thank you for checking out our video today. Now, before we get started with today's free Forex training video, I want to give you a chance to pause this video right now and go to our website. Trade Advisor Pro offers you free Forex training videos, and trade alerts. And folks, you do not want to miss our trade alerts. We send out a bunch of trade alerts every month that are top rated in the industry. We send you our exact trades right to your inbox. Pause the video now. Go to tradeadvisorpro.com/free, and all you have to do is register and then come back to this video, and we'll be sending you a lot more goodies to help you with your Forex trading. Enjoy today's training video. Alright everyone, before we start getting into the rest of the training course, which is going to be very in-depth on taking you through how to trade the markets, how to determine trends, a slew of trade examples. We're going to show you live trades that I'm taking and how I'm managing the trades. I mean, we're going to show you very detailed. But before you even pull that trigger and take a trade, we have to focus on equity and risk management. Now folks, listen to me. This is the cornerstone, the very foundation of all your Forex trading. Because if you don't have this part right, you might as well hang it up now. You're going to lose, period. There is no way you can be successful in Forex without having a proper equity and risk management game plan. So let's get into some of the details that it takes to put together an equity and risk management plan, and we'll take this step by step. So before we get into these keys to success to having a properly equity and risk management plan, we need to talk about why equity and risk management is the biggest factor in your success as a Forex trader. The number one reason is 90+% of all Forex traders fail. Out of the 10% who win, some of them are break even or slightly winning, and then usually 1% are cleaning house. And I happen to be in the 1%, so listen to me. I've been through the ringer. I've made all the mistakes you could possibly imagine. I've traded without stop losses. We'll talk about stop losses a little bit later. And have lost over $100,000 in a day because I didn't trade with a stop. This is years ago when I was just probably a year and a half after I was first getting started. I've made all the mistakes you could possibly imagine, and I'm taking that information to put in here to help you to put together a proper equity and risk management plan. So the number one reason most Forex traders fail, I told you about that 90%, is because of equity and risk management. Taking a good trade is great. Taking 5 good trades is great. But what happens when you have a string of losses, which happens to everyone? In fact, one of my mentors, who is one of the most wealthy people that I know, who's been extremely successful as a Forex trader, told me that even the best traders in the world are going to have a string of losses of 10 in a row. And I never thought I would actually hit that number because I have a very tight system that keeps me in check to make sure I don't do that. But I did make a mistake that I didn't even think about. But because of that, and the market turned very quickly, and I'll get into that a little bit later and I'll explain, that I ended up losing 10 trades in a row at one point. And so because of that, because I have a proper equity management plan, because I know how much to risk per trade, I didn't freak out. It didn't affect my accounts, not substantially, not enough to wipe out my emotional charge. And so we want to get into this because I want you to understand that these keys here are vital for you to follow. So before you start trading, take your time. I know a lot of people are sitting here thinking, hey, just get me into the trading. Trust me. Take your time to go through these videos. The video's not going to be very long, but we're going to explain some things to understanding your how to put together an equity and risk management plan. Okay? So first thing, the first key to success is to control your emotions. And we're going to get into that a little bit more in depth. How much should you risk on a trade or in all of your trades at once? How to put together a predefined game plan, your Forex trading plan. How we're going to manage the trades once we get in them. We're going to focus on removing our risk quickly from a trade. and I'll show you some examples of that. And then we're going to talk about reward to risk, which is extremely important. And probably the most important thing is once you've got all this put together, the most important element is to stick to your game plan. So once you have a good, solid equity and risk management plan in place, stick to the game plan. Do not continue to make changes and adjustments and break outside of that mold, because it's when you break outside of your equity and risk management plan is when you're going to start seeing a world of hurt in your Forex account. Okay, so let's get to the first one. This one we're going to talk about the first two actually, which is controlling your emotions and how much risk you should take on a trade. Now, my customer service team gets emails every single day. Customers asking, how much should I be risking per trade? And we really can't answer that. And we can have suggestions, and we'll talk about these suggestions here in a minute. But how much you should risk per trade is more going to be determined on your risk appetite in your account balance. Now, if you have $500 of play money in there, you may be more open to risk because you're willing to lose that capital. But if you have $300,000 in an account and you are making a living trading, you have to be a little bit more risk adverse. All right, so we'll talk about that. So here's the biggest key, and the biggest question you need to ask yourself is, number one, I want you to think right now about your trading account, and especially if you have live funds. Okay, how much is in your trading account? Now I want to ask you, how much of that trading account could you lose before you start sweating bullets? Is it 5%? Is it 10%? So if you have let's say you have a $10,000 account, can you lose $1,000 in your Forex trading account before you start sweating and feeling the pressure? Okay? You should be able to. 10% is not that big of a deal. So you got to think to yourself, what if I lose 5 or 6 trades in a row? 3, 4, 5, 6 trades in a row. Now you don't want to be risking 10% per trade, because if you lose 3 trades in a row, you're down 30%. And I can tell you right now, there's nobody on this planet who's going to put $10,000 into a Forex account, lose 30% of it on 3 trades, and not be sweating. So part 1 of controlling your emotions is not over risking your account that's going to cause you to think irrationally. And here's what I mean by that. A lot of times what most traders end up doing is they over risk their account. They're risking too much per trade. They have a series of losses, which means they have some serious drawdown on their account, and in order to gain that back, they start making very unwise choices. They start risking even more, and they end up getting, instead of gaining their account back, that actually cause more damage and ultimately end up blowing their account. So what happens over and over and over. You listening to this video are no different. You're no different. The number one key to successful traders is controlling your emotions. I can teach you how to trade. Folks, if you go through the entire course, take your time, take some notes, start playing with the demo account, you can learn to be successful as a trader. I'm telling you now, you watch through this entire course, you're going to be successful if you follow the game plan. There's no doubt about it. But the number one thing I can't control is, are you going to be trigger happy and making unwise choices because you've risked too much and now you're trying to do what's called revenge trading and try to earn your account back. And so you have to control your emotions, which is why, let's go back to our $10,000 example. If you can handle losing $10,000 on your, $1,000 on a $10,000 account, knowing that you could probably lose 3 to 5 or 6 trades in a row, that means you can risk no more than 2% of your account balance per trade. You have to think about the worst case scenario. If you lose 5 trades in a row at 2% risk, you lost 10% of your account. If you lost 10% of your account, you can always stop trading take a breath for a couple days, couple weeks, couple months. Get your game plan back on. Play around in a demo account again before you start moving back on. Okay? Your number one goal is to continue trading and to make sure that your emotional state is not at a point where you're going to make unwise decisions. So, number one, control your emotions, and we're going to do that. One of the main ways is to control how much you're going to risk. So let's talk about risk. Now, using the example I just gave you before, 2% per trade is the maximum you should risk. In fact, that's a guideline that I use. I rarely ever trade more than 1 to 1.2% per trade, because my account balances are most likely larger than the majority of the people watching this video course. I am not really interested in losing 10% of my account balance. 10% of my account balance is vast. It is well into the six figures, and I'm really not interested in losing that kind of money. And so, my trading accounts are more for long-term approach. They're creating and building wealth, and therefore the gambler in me, the mentality of I have to double my account every 3 months, is not there. I'm thinking more like an investor, so 1% per trade is fine, because if I do lose 3 to 5 trades in a row, I can handle 3 to 5% loss on my accounts. Now for me, 2% per trade and I lose 3 to 5, that's 10% of my account balance. To me, that's risky, that's scary to me, so that I don't do that. So for me, it's 1%. I would suggest for you, no more than 2%. I know some people that do 3-4% per trade. If you have a smaller account, it's probably fine, but my suggestion is 2. I also suggest that you don't risk more than 5% of all your trades. So if you're going to do 1% per trade, 2% per trade, but you're going to be in 5 trades, then I suggest you cut them all down to 1%, so that if a huge market move happens, you don't get stuck in 10 different losing trades. Okay, you might be stuck in 5 different losing trades at 10% risk. You only want to risk 5%. So, and also, here's a big key. This is what I'll talk about when I talked about how I had lost 10 trades in a row. So this is how I added this to my game plan. No more than 2 like-minded pairs. Now let me show you this example. So in this example, I'm showing 4 currency pairs: the euro dollar, the euro yen, the euro Aussie, and the euro pound. Now, these are all like-minded in the fact that they all have the euro in them. Okay. Now let's say that I'm in 4 different euro positions. All 4 of these trades I'm in at once. And then out of nowhere, in the eurozone, a huge market announcement comes out about the euro is going. The eurozone has bankruptcy potential sitting on the verge, and some countries going bankrupt or something along that line. The euro is going to drop so significantly that you could very easily get stopped out of 4 trades at once. So what happened is because you were in 4 different euro trades, you're putting too much risk by putting everything you've got into the euro. So I'm going to suggest no more than 2 like-minded pairs. Even if you see 4 amazing trade setups, choose the 2 top ones. If the euro dollar and the euro yen are the 2 top trades, take those 2 trades. But don't take more than 2 like-minded pairs. Now let me explain why I added this to my plan. I told you earlier in this video that one of my mentors who coached me on how to trade at the very beginning told me that even the best traders are going to lose 10 trades in a row at some point in their life. I had never done that. In fact, at the time shooting this video, I've been trading now for 8 years. I've never lost more than 5 trades in a row, ever. But in October of 2012, which is approximately 4 months ago, I had set up saw a tremendous number of trade setups that were just looking really great. The trend on the euro and the pound were both up. So I set 5 pending orders on the euro and 5 pending orders on the pound. Now these are all different cross pairs like euro dollar, euro yen, euro pound, euro Aussie. I forget what the other one was. And then I also chose 5 trades that were on the pound. Now the euro and the pound are very correlated. Okay, so I really had 10 trades that were very like-minded. And sure enough, a big announcement came out. I think it was that the Eurozone was going to be selling off an unlimited amount of debt instruments, which I forget what exactly it was. I'm just trying to guess offhand. Something that caused the euro to go nuts. Now, here's the deal. The market was up. I was looking for these pairs to pull down, to drop, or what's called a retracement, to take us into an entry and then shoot up over a period of time. And because I set all 10 of these trades, I figured within the next day or so we might hit 2 or 3 of them. But what happened is the market moved down so abruptly that all 10 of those trades hit, and within a day and a half they were all stopped out. I lost 10 trades in a row. Now, so immediately I went back to my equity management plan, and I made a commitment that I will not trade more than 2 like-minded pairs. For example, you see on the screen the euro yen. Now right now, at the time of this video, the yen cross pairs, pound yen, euro yen, Swissy yen, Aussie yen, dollar yen, have been shooting up. In fact, the euro yen's gone almost up 3,000 pips in the last 5 months. So, knowing that, even though these pairs are trending up strongly, and we've been trading a lot of yen cross pairs, waiting for a drop down to take us an entry to shoot back up. We'll talk more about that later. I made a commitment to myself to only take 2 trades. So I've been trading a lot of the euro yen and the dollar yen. Have traded very well. In fact, over the last 3 weeks, I've won every single one of those trades. A couple of days ago, I took 1 on the Aussie yen. So the point I'm trying to make is if I took 5 yen-based trades, and all of a sudden some news comes out that causes the yen to strengthen tremendously, it could reverse all of these trades and I could be stopped out on all 5 of them. I'm willing to be stopped out in 1 or 2, but 5 in a row, that pushes me beyond my emotional point. Okay? And so going back to what we talked about, 2% risk maximum per trade, 5% max risk at once across all your trades is what I suggest, and no more than 2 like-minded pairs at once. Very, very important. So next on our list is to have a predefined trading plan. Okay, let's talk about some of the keys to success to having a predefined trading plan. Now, before we get into that, underneath this video, there is a little worksheet on that you can put together your own trading plan. And I highly suggest you fill that out and stick to your plan and sign it, because you are making a commitment to yourself that you're going to stick to a game plan. So number 1 in the game plan is talking about how much are you going to risk per trade. Okay? How long do I stick to this? In other words, if you commit that you're going to risk 1% per trade, are you going to stick with that for the next 90 days? Because you can always adjust your risk parameters. Okay, if you see that you're trading extremely well over a 90-day period and you've been risking 1%, maybe it's time after that to adjust your plan and bump it to 1.5%. But once you create your plan, you stick to your plan. So if you commit to 90 days at 1% risk, then you commit to 90 days at 1% risk. Okay. You're also going to make a commitment that you are never going to move your stops further from your open, but you will move them closer to your open. Now here's what I mean by that. Let's say we have a trade with a 100 pip stop. This happens all the time, folks. In fact, my customer service team just got an email for a customer a few days ago somebody who bought the pound right where they should have sold it. Right now the pound is 400 pips down. They had a decent stop loss in the first place, but what happens as this trade started dropping, they didn't want to get stopped out, so they kept moving their stop down further and stop down further and stop down further in hopes that the trade would go back up and they wouldn't lose money. Folks, that's gambling. You're taking too much risk. That plan never works. You calculate each trade, you know how much you're willing to lose, and you take the emotions out. If this trade gets stopped, next. It was nothing but a transaction. Period. No emotions involved. It was a transaction. So once you set your stop and you've followed a game plan, so you have the exact amount of lots determined, and you're in that trade, you do not move your stop further from your open. That just adds more risk to the trade. But we're going to show you a little bit later here that you actually are going to move your stop closer to your open. So in other words, if the customer, let's say he bought the pound at 1.6, okay? 1.6000, and he had a 100 pip stop loss at 1.59000. Now once that trade started going up, let's say at 1.6100, we're going to show you how to manage the trades here in a little bit, but we're going to close part of your positions, okay, to get some profits now. At that point, you would move your stop loss to your open price or even higher. Why would you do that? Because if the trade comes against you at that point and decides to drop down again, you've already locked in your profits and you've locked out any risk of loss on the trade. Your number one goal is to remove the risk from the trade as fast as possible by removing the stop, and not by deleting the stop, but by moving the stop so that even if you were stopped out, you'd be stopped out in profit. Okay, so you're never going to move your stops further, but as you're managing the trade in profit, you're going to continue to move your trade closer and beyond your open to lock in profits. And this next step is, this is something I don't see a lot of people doing, but you're going to have a predefined lot size for your trades in advance. So you already have a game plan on your trades. So I'll talk about that in a little bit, and we'll show you how to put that together. In fact, there's going to be a worksheet, a little thing that you can fill out and print off and stick to your computer. Underneath this video, a little link that will show you that you can use to actually fill that out, and so you have your lot sizes predetermined. Okay, so the first thing we're going to talk about is how to calculate lots. This is a question we get a lot. Is how do I calculate how many lots you're going to trade? Now, here's one thing I want to tell you for sure. Always use micro lots. And I have customers calling me, yeah, I've got a $5,000 account. I want to use standard lots. Number one, using standard lots as $10 per lot per pip. If you take a trade with a 100 pip stop, you're risking $1,000 on a $5,000 account. That's 20% risk. Stupid. You can't do it. Okay. Micro lots. Okay, now listen, I have accounts that are over $1 million, and I still use micro lots on all of them. And here's why. One standard lot, which is a 100K lot, one standard lot is worth on most pairs $10 per lot per pip. All right, so if I trade one standard lot, every time that pip moves up or down 1 pip, I'm gaining or losing $10. Okay. Now, if you use micro lots, what do? Well, you just trade 100 micro lots. It's the same stinking thing. You understand? 100 micro lots is the same thing as one standard lot. So, the difference is, if you have an account that's set for standard lots, and you're trading one standard lot on that account, and your trade is going in your direction, looks great, now you decide to close half your position, okay, lock in some profits, and then you're going to move your stop to break even on the rest of the trade. You can't do it. If you're stuck in an account with standard lots, you can't cut standard lots in half. You have to close the whole trade out completely, which means you're throwing a lot of money away that you would normally have the opportunity to get, because we're shooting towards our profit target. And as we're shooting towards our profit target, we're closing out partial positions until that trade either hits our profit target or it dies out and gets stopped out deep into profit. But let's say instead of having a standard account lot, you had a micro account lot. You're trading 100 micro lots. That trade went up 50, 60 pips. You decide to close the after position. What do? You just close off 50 micro lots, and what are you left with? Yeah, 50 micro lots. Perfect example. I was trading the Aussie dollar. This is several months ago. And that thing moved 300 pips, I think it was, over a 5-day period. And we got it in an excellent entry. In fact, our risk reward, which we'll talk about later, was great. And as that trade started moving up, I closed out 50% of my position, moved my stop to break even. It moved up another 50 pips. What did I do? You got it right. I closed out another 50%, moved my stop up. I kept doing that and doing that and doing that. And even at 1% risk, I gained a 3.5% gain on that trade. And eventually, the pair dropped, and it hit my stop loss, which was 225 pips in the profit. Okay? Now, so I'm telling you, no matter how big your count is, put your ego away. Micro lots, the pros, unless you're managing, millions and millions of dollars of your own money, a pro trader is using micro lots because you have full control over your lot sizes. Now, I closed that Aussie dollar position 6 times. Kept closing 50%, moved up more, closed another 50%, moved up more, until all I had left was a couple of micro lots. Okay, and I think I originally started off with 400 micro lots. Okay, on one of my accounts, and so what you got to understand is if you had been trading standard lots on that trade, you would have only been able to close twice before you were closed out. Okay, so always use micro lots. Very, very important. Let's get to the next steps of calculating your lots. All right, so we're going to use an example here. Let's say you have a $10,000 account, and you already made a decision and committed in your trading plan that you're going to risk no more than 2%. All right. Now, 2% of $10,000 is $200. So you are willing to lose no more than $200 per trade. Are you with me? That is the number one key, is you already preset in your equity management plan your maximum that you are willing to risk per trade, and you stick to the plan and don't change it. So in this example, 2% risk, you are willing to risk $200 on a trade. All right. Now the next step you need to do is look at your trade, and we'll talk about later on optimal entry and exit points, and you're gonna know in advance. In fact, you're gonna be setting these trades in advance. So every time you take a trade, you're gonna know 3 things. You're gonna know, number 1, exactly where you're gonna get in. Number 2, exactly where you're gonna place your stop. Number 3, exactly how you're gonna be pulling your profits out. You already know in advance how you're gonna manage each trade. So the first thing you need to do is calculate the number of pips from your open price, which is the price you're gonna get in at, and your stop. So let's show you a couple examples. All right, in this example, we are buying the euro. In fact, if you see this right here on the screen, our pro signals direct customers. This is exactly what a signal that we would send out to them would look like. It'll say buy limit. That means you're buying a pending order on the euro US dollar at 135.00. Our stop loss is 134.00, and our take profit is 137.00. Okay, now using this example, what is the distance between the open price, which is 35.00, and your stop loss? It's 100 pips. Okay, how do you calculate that? You subtract 134.00 from 135.00. You get 100 pips. Okay. You have already committed in the last slide that you were going to risk $200 per trade. Okay? So you're going to take that $200 and divide it between those 100 pips. So you are willing to risk $2 per pip. So $2 per pip, if the trade went against you 100 pips, it would hit your stop loss, it would close your trade out at a $200 loss. You lost 2%. All right? So now here's one thing that you need to understand is 1 micro lot is approximately 10 cents. Now some pairs, especially the yen cross pairs, they're a little bit different. Some pairs are actually a little bit more. Sometimes they're a little bit less. But on average, they're about 10 cents per pip. 1 micro lot. Okay? Now, we already said we are going to risk $2 per pip. Okay? So you can divide $2 into 10 cents and you get 20. An easier way to calculate it is take the $2 and put a 0 at the end of it. Okay? It ends up being the same number. But when I start showing you how to quickly calculate lots, it's a lot easier just to add the 0. So you are willing to trade 20 microlots on that trade. At 20 microlots, if the trade went against you, how much did you lose? You got it, $200, 2% risk, and you are not freaking out. All right, so let's look at another trade example. Almost the same trade, a little bit different. This one says we're going to buy the euro at 135.00, but our stop loss is 134.50. So we're using only a 50 pip stop. The difference between 135.00 and 134.50 is 50 pips. So we are going to take our same $200 maximum risk, and now we're going to spread that between 50 pips. Okay? Which equals $4 per pip is what we're willing to risk. Again, 1 microlot is 10 cents. You take the $4 per pip, divide it into 10 cents, and what you get is 40. So in that trade, you're going to be able to trade 40 microlots. Okay, this is very important that you understand how to calculate this. If you don't do that, rewind the video a couple minutes, go back to example 1, example 2, watch them a few times so that you understand. In fact, try some examples on paper and see if you can come up with your lot sizes. Okay. All right, now once you understand that, how to calculate your lots, before you even start trading, you should have predefined lot sizes. Now here's what I mean. You should already know in advance, anywhere from 30 pips to 120 pips, how many lots you're going to be trading. So here's how I calculated this number. And let me pull up a calculator on this screen. And right here you can see that, in fact, underneath this video there's a little worksheet to your predefined lot sizes. You can fill that in and cut it out and put it on your computer, in your wallet, whatever you're doing, if you trade on your phone or on your computer. And that way you're following the same plan in advance. You already know exactly how many lots you can trade based on the stop loss. Okay, so if, let's say you take a trade and it has a 30 pip stop loss. All right, now let's talk. You already know your max risk is $200. It could be more or less depending on your account, but this is just for examples. And so we're going to take $200, divide it by 30, equals 6.66. What you're going to do is move the decimal point one time over, or technically you're multiplying it by 10. And you can trade 66.6 lots or 67. You can choose whichever one you want. So same thing with a 50 pip stop. You take $200, you divide it by 50, you get 4 times 10, or divided by 10 cents, the same number, 40 microlots. So any trade that you choose that you are going to use a 50 pip stop, you're going to trade 40 microlots. And you can go all the way up. I actually have a 30 to 150 pip predefined lot size card right on my computer. I know exactly how much I'm gonna trade, exactly the number of lots. So even at let's say at 100 pip stop, you take your $200 max risk, divide it between 100 pips, multiply by 10. I'd be willing to trade 20 microlots based on my risk parameters. Okay, so follow the card below and print that off, cut it out, use the card, because that way you know in advance exactly how many lots you're going to be able to trade on each trade. All you have to do is calculate the distance between your stop and your open price, which is the price you're going to get in. Follow your card, and you are risking the exact amount across the board at the same time. Okay, let's briefly cover trade management. Now, in this little section here, we're still in the equity management section. We're not going to get deep into trade management, because a lot of the trade management is actually going to be examples, and I'm going to show you live trade examples of trades that I'm in and how I'm managing them. You're going to get to watch me do the whole thing. So the first thing you need to understand in trade management is that the number one thing in managing your trade is, and this is once you're in the trade, is we're going to try to remove risk from the trade as much as possible. One of my favorite quotes and I do this in my webinars all the time. I talk about this quote by Roy Rogers. And here's what a quote that Roy Rogers said. He said, "I am not as concerned with return on my investment as I am with return of my investment." The number one thing that an investor looks at is what happens if everything fails. How can I protect my assets? Okay, cover your assets. So the number one thing we're going to try to do is remove the risk from the trade quickly. So if you have 2% risk on a trade, our goal is how can we move that quickly so that you're only risking 1%, and eventually you are at a point to where you're risking nothing on your trade. You're going to be what you call in a funded position. Okay, so the first thing we're going to do, and we'll get more into trade examples later on in this course, but as a trade starts to move up, let's say let's talk about those examples that I showed you earlier. In fact, let me go back to one of these examples real quick. Now let's use this example. Let's talk about, in this trade, we have a 50 pip stop on this trade. All right, we buy the euro at 13500. We have a stop at 134.50. What I usually do in a trade like this is once this trade gets up 40 or 50 pips, I will close out 50% of my position. We talked about that earlier. Okay, close out 50% of my position. Boom, I just made a profit. Okay, and then I move my stop loss to either 13500 or maybe 135.05. Why? Because if all of a sudden the rest of the trade drops, I'll at least get stopped out on break even on the second half. In the first half, I made a profit. You removed the risk from the trade. If you can remove your risk from your trades by learning how to manage each trade and how to move the stops, your losses will be much smaller than your wins, and your overall success as a Forex trader will be tremendously higher. So I'm not going to get too much more detailed in trade management because that's going to be in a whole new section in this training course. But I wanted to at least cover that as part of an equity management plan, is you have a game plan of how you're going to manage your trades in advance. Now, this is one of the biggest keys. In fact, in the slide I showed you earlier, I had this one starred. This is reward to risk. And if you follow this piece, I'm going to show you here in a few minutes that you could actually lose 50% or more of your trades and still be very profitable. Now let me show you why. First, what is reward to risk? Well, it's pretty easy. In this trade example, which is one of the wins we had above, we're buying the euro at 13500. Stop loss is 13400. Our take profit level where we're planning to close our trade is 13700. Now, the distance between open and the stop is 100 pips. Okay, your distance between your open and your take profit, which is your profit target, is 200 pips. So what's that mean? Your reward to risk is 2 to 1. That means either way, you're risking 100 pips, or in this example, 2% of your account balance. But if the trade goes your direction completely, you have a gain potential of 200 pips and 4% reward. Does that make sense? Now, you always want to focus on having a reward to risk of 2 to 1 as much as possible. Now, when you're taking scalps in the market, 1 to 1 is normal because you're taking small pieces out of the market. It's a little bit different. But in these examples, and most of this training course is going to be focused on longer term trading, though we will get into some scalping later. But we want to focus on having a reward to risk of 2 to 1. Now, for example, if we look and we see that the best place to buy the euro is 13500, and the best place to put our stop, and we'll get into those examples later, is 13400, great. But let's say we think the thing is going to turn around at 135.60 and drop. Well, at that point, we're risking 100 pips for the potential chance to make 60 pips. Now, what we talked about earlier, that this Forex trading is a game of probabilities. You need to put the odds in your favor. In that example, you're risking 100 pips, but you only have a potential gain, and that is potential gain of 60 pips. It's not worth it. Your risk to reward is 0.6 to 1. It doesn't work. Okay? So you would just skip the trade, just forget it. Or you should go down to a lower time frame and see if you can take that same trade with a tighter stop, but you're trading it off of a different time frame, and we'll get into those examples later. Let's look at another example. All right, in this example, which is one we used earlier, we have a 50 pip stop. Okay, so our distance from our open price to our stop is 50 pips. And using that same trade example, like, let me stop the slide and fix this. There we go. The trade example was supposed to be 13700. Is the distance from open to take profit is 200 pips. Now, in this example, we're risking 50 pips for the chance and a good probability that we feel that the trade will go in our direction 200 pips. In this example, our reward to risk is 4 to 1. Now that's killer. Now if you can stay at 3 to 4 to 1, you are kicking butt. Harder to find, but at least stick with 2 to 1. Now let me show you some other things here. All right, if you will stick with 2 to 1 reward to risk or better, I'm going to show you here an example how you can lose 50% of your trades and still be very profitable. Okay, this is one of the biggest keys to success as a trader. Okay, in all these little pieces in this whole equity management plan section, if you follow each one of these steps, folks, I'm telling you, and then you just slowly take your time and learn how to trade, you're going to kick butt in the market. If you don't, you skip the equity management, you're going to get bombed. I'm just telling you now, guarantee it. So let's show you how. All right, so let's go back to that trade example we showed earlier here, where we had a 50 pip stop. Okay, so we're risking 2% across 50 pips, and let's talk about if this trade hits full stop or full take profit, which forget about managing the trade and closing out partial positions and moving the stop. Let's talk about if we let this trade get completely stopped out, or if we let the trade get completely hit our take profit level. If we get stopped out at 50 pips, across those 50 pips we lost 2%. Okay. Now, if the trade goes for us in our direction and hits our 200 pip take profit level, we've gained 8%. Because if you have a 50 pip stop and you're risking 2%, every 50 pips that the trade goes in our direction, we're also gaining 2%. So let me show you a really cool example. Taking the same exact trade example we just showed with a 50 pip stop. Let's say we take 20 trades, all the same thing. Okay, all of the trades are 50 pip stops, and all the take profits are 200 pips. We either let them get stopped out or hit our take profit. I'm just showing you for ease of numbers. Okay, let's say we have, out of those 20 trades, we have 10 winners and 10 losers. So 50% of them win, 50% of them lose. With the 10 losers at 2% risked at each trade, we've lost 20%. With the 10 winners all hitting a 200 pip profit target, we've gained 80%. So we take 80%, we subtract 20%, and guess what? We still have 60% gain. This is a perfect example of the fact that you can still lose more than 50% of your trades and come out extremely profitable. Now, I don't want to use that number, 60%, because reality, folks, you're not going to be making 60% a month in your account. That is nuts. Most people do not even come close to that. You want to be thinking about steady gains, but just an example. But even if you go back to the example, so if you went back to the 2 to 1 ratio, let's say we have a 100 pip stop and a 200 pip take profit. Okay, so same risk, 2%. If we have 10 trades that go against us 100 pips, 10 trades that go for us 200 pips. So with those 10 losers, we still lose 20%. With the 10 winners, we made 40%. So you take 40% positive minus 20% losses, and you're still up 20%. So even at a 2 to 1 risk to reward to risk ratio, you can lose 50% of your trades and still come out extremely profitable. Okay? Now, folks, listen to me. We're about to get into some of the more detailed sections of the course, probably the funner parts of the course, which is we're going to learn how to trade. And this is honestly the most fun part. What I just showed you, the equity management part, this is the boring part. But honestly, this is the business plan. This is the foundation of how you're going to build your business as a trader. Without the foundation, you're not going to be successful. So once you've gotten this all put together, and you've followed the worksheets, and you've put together your little game plan, stick to your game plan. Follow the game plan that I just outlined for you. Draw up your own game plan. follow the game plan, and then let's see you on the other side as a successful trader. Folks, I hope you enjoyed today's training video. If you have not done so already, stop this video now and go to TradeAdvisorPro.com/free and register absolutely free for free Forex training videos, and free Forex traded alerts directly to your inbox. Go to the website right now and register for free. All kinds of goodies for you. Thanks a lot.